Welcome to the training for Volunteer Income Tax Assistance, also known as VITA. Session 8, California versus Federal Tax Law. This training is presented by the Franchise Tax Board's VITA trainers. Hi, I'm Tom.
And I'm Trudy.
The Franchise Tax Board is proud to offer this training series for the upcoming filing season. We have created these training videos with California VITA volunteers in mind. This is the 8th of 13 sessions, and we hope you find them helpful as you work on your VITA certification.
If you have any questions, please contact your local VITA coordinator. You may also reach out to FTB's VITA team at 800-522-5665 or by email at volunteercoordinator@ftb.ca.gov.
Okay, let's get started. In this session, we will review the areas where California does not conform to federal tax laws. Personal exemption deduction. The One Big Beautiful Bill Act of 2025 made the elimination of personal exemption deduction permanent on federal returns. California does not conform to the elimination of the federal personal exemption deduction. California has a personal and dependent exemption credit, not a deduction. The personal exemption credit for taxpayers, spouses, and qualified dependents may change from year to year. For the personal exemption credit amounts, refer to FTB 5130, Volunteer Reference Manual. California has its own standard deduction amounts for each filing status. These amounts can be found in the FTB 5130 VITA TCE Volunteer Reference Manual. State and local tax. California does not conform to the federal, state, and local tax, also known as SALT, deduction limit of $40,000. California allows the deduction of real estate and personal property tax paid, but does not allow the deduction of local and state income taxes. California allows moving expense reimbursements as well. Mortgage interest. When it comes to mortgage interest, if the debt incurred prior to December 15, 2017, an individual may deduct mortgage interest on a qualified residence of no more than $1 million. California conforms to the $1 million mortgage loan cap. California does not conform to the $750,000 of mortgage loan cap set by federal law for tax years 2018 and after.
For federal, home equity loan interest can be deducted up to a maximum combined $750,000 of the first and second loan amount, as long as the loan was used to purchase, build, or substantially improve the home. California does not conform. California allows the interest paid on a home equity line to be deducted up to $100,000, regardless of how the home equity line is used. For charitable contributions, California does not conform to federal limits. California allows up to 50% of cash limit donations. Refer to Publication 4012 for federal charitable contribution limits. Miscellaneous itemized deductions. The federal tax law permanently suspended all miscellaneous itemized deductions that are subject to the 2% above adjusted gross income. California does not conform. To obtain miscellaneous itemized deductions for California, use Federal Form 2106. Under certain circumstances, Federal allows a deduction of up to 20% of qualified business income. California does not conform to this deduction and does not have a comparable deduction. Federal has a child tax credit and a credit for other dependents. California has the Young Child Tax Credit. You have now completed the 8th of 13 VITA training sessions. All sessions are available on the Franchise Tax Board website at ftb.ca.gov. Again, if you have questions, please contact your local VITA coordinator. You may also reach out to FTB's VITA team at 800-522-5665 or by email at volunteercoordinator@ftb.ca.gov. Keep practicing. Thanks for watching.